What if I told you that while you were sleeping, over $15 trillion vanished from the precious metals market in a coordinated move that will reshape the global financial system? And what if the man orchestrating this entire strategy just placed one of his most trusted allies at the helm of the most powerful financial institution in the world? This isn't just about silver prices. This is about a financial war that's been brewing for years, and we just witnessed the opening shot. Let me start with the numbers because the scale of what just happened is almost incomprehensible. Silver prices collapsed by 30 to 40% in a single trading session, plunging to $80.55 per ounce. Over $15 trillion in value was wiped from gold and silver markets in just 24 hours. That's half the size of the entire United States economy. Half, gone, in one day. This was the biggest single-day crash in silver since March 20th, 1980, when the Hunt brothers' attempt to corner the silver market spectacularly imploded. But what we're witnessing now isn't about two billionaires making a bad bet. This is about something far more strategic, far more calculated, and far more dangerous for the global financial system. And it all centers around one name, Kevin Warsh. President Donald Trump just nominated Kevin Warsh to run the Federal Reserve. And if you don't understand who Kevin Warsh is and what he represents, you cannot possibly understand what's happening to silver right now. This nomination wasn't just a political appointment, it was a declaration of war on the existing financial order. Kevin Warsh served on the Federal Reserve Board of Governors from 2006 to 2011, right through the heart of the financial crisis. But what makes him particularly dangerous to precious metals investors is what he's been saying since he left the Fed. Warsh has been one of the most vocal critics of the Federal Reserve's easy money policies. He's warned repeatedly about excessive money printing, artificially low interest rates, and the Fed's bloated balance sheet. But here's the critical part. Warsh is a strong dollar advocate. He believes the dollar's role as the global reserve currency is non-negotiable and must be defended at all costs. He's argued that one of the Fed's primary responsibilities is maintaining confidence in the dollar, even if that means making unpopular decisions. And he understands that high precious metals prices are a direct threat to dollar credibility. Trump knows exactly what he's doing here. Throughout his career, Trump has been obsessed with projecting strength. A strong dollar means a strong America in his worldview. It means continued global dominance of U.S. financial markets and the ability to weaponize the dollar against adversaries. But there's a fundamental problem. You cannot have a strong dollar and strong precious metals at the same time. They move in opposite directions. When faith in the dollar rises, precious metals fall. When faith in the dollar falls, precious metals soar. By nominating Warsh, a known inflation hawk and dollar advocate, Trump essentially fired a warning shot across the bow of the precious metals market. The message was clear. The U.S. government is going to defend the dollar, and if that means crushing gold and silver prices, so be it. Now let's examine what happened in the 24 hours surrounding this announcement, because the details reveal a coordinated operation that would make military strategists proud. The sell orders didn't come during regular trading hours. They hit in the middle of the night during Asian trading sessions when liquidity is at its thinnest. This is textbook manipulation tactics. When you want to move a market with minimal resistance, you strike when there are the fewest participants to absorb your orders. Massive quantities of paper silver futures contracts flooded the COMEX exchange. Hundreds of millions of ounces worth of paper contracts dumped onto the market in concentrated bursts. Here's the smoking gun that exposes the manipulation. While paper silver was collapsing, physical silver dealers reported something extraordinary. Premiums, the amount you pay over spot price to buy actual coins or bars, skyrocketed overnight. Some dealers reported premiums jumping from $3 to $4 per ounce to $10, $15 per ounce. People were paying massive markups because they understood the paper price didn't reflect reality. This divergence between paper and physical is the evidence everyone needs to see. In a legitimate market crash driven by fundamentals, both paper and physical prices move together. But when paper crashes while physical premiums explode, it tells you the paper market is being manipulated and the real market is rejecting those prices. Let me explain how this works. The silver market operates on two levels, paper and physical. The paper market is where futures contracts and derivatives trade. The physical market is where actual silver changes hands. Here's the problem. The paper market is exponentially larger than the physical market. For every ounce of physical silver that exists, there are estimates of 100 to 500 ounces of paper silver claims. This means the paper market is essentially a leveraged bet on silver prices, not actual silver ownership. When someone with deep pockets wants to manipulate the price, they flood the paper market with sell orders that have no relation to physical supply and demand. This is exactly what happened. Large institutional players, likely coordinating with central bank interests, dumped enormous quantities of paper contracts onto futures markets. Algorithm-driven trading systems saw these massive sell orders and automatically triggered their own selling programs. High-frequency trading computers piled on, creating a cascading effect. Within minutes, the price had crashed 20, then 25, then 30%. But none of this changed the fundamental reality of physical silver. Solar panel manufacturers still need silver. Electronics producers still need silver. The green energy transition still requires massive amounts of silver. Investment demand from people who understand what's happening is actually increasing. The real supply and demand situation hasn't changed at all. Only the paper price changed. Now let's talk about why this matters on a global scale and how Trump's strategy fits into the bigger picture. For the past several years, countries around the world have been slowly moving away from dollar dependence. China and Russia have been building alternative payment systems to avoid SWIFT, the dollar-dominated international payment network. The BRICS nations have been discussing creating their own currency or expanding trade in local currencies. Saudi Arabia has been making noise about accepting currencies other than dollars for oil sales, breaking the petrodollar agreement that's been in place since the 1970s. All of these moves represent existential threats to American financial dominance. And what's been the primary hedge that these countries have been accumulating? Gold and silver. China has been accumulating gold reserves at an unprecedented pace. Russia converted massive dollar reserves into gold before being sanctioned. Central banks worldwide added over 1,000 tons of gold to their reserves in 2023 alone, the highest level in decades. This is the context in which Trump nominated Kevin Warsh. This nomination is part of a broader strategy to reassert dollar dominance and punish countries moving away from the dollar system. By crashing precious metals prices, they achieve multiple objectives simultaneously. First, they inflict losses on countries holding large gold and silver reserves, making them question their de-dollarization strategies. Second, they demonstrate that the U.S. still has the power to move global markets. Third, they shake confidence in precious metals as an alternative to the dollar. Kevin Warsh understands this dynamic intimately. During his time at the Fed during the 2008 financial crisis, he saw firsthand what happens when confidence in the financial system evaporates. He saw gold prices soaring as people fled to safety. Those experiences shaped his views on the absolute necessity of defending the dollar's status. Warsh has written extensively about what he calls the central bank put, the idea that central banks will always step in to prop up markets. He's criticized this approach as creating moral hazard, but he's also acknowledged that there are times when central banks must act decisively to prevent systemic collapse. From his perspective, soaring precious metals prices constitute a systemic threat that requires decisive action. Rising gold and silver prices signal a loss of confidence in monetary authorities. They suggest people don't trust central banks to maintain price stability. They indicate investors are seeking alternatives to the dollar system. All of this undermines the Fed's credibility and, by extension, American financial power. So, from Warsh's viewpoint, crushing precious metals prices isn't manipulation. It's a necessary defense of the monetary system. Consider the casualties of this crash. Chinese investors who had been accumulating silver got hit hard. Russian reserves held in gold lost value. Mining companies in South America and Africa saw their stock prices collapse. Retail investors around the world who bought precious metals as inflation hedges watched their portfolios crater. All of these groups have one thing in common. They were betting against the continued dominance of the dollar system, and they just got taught a painful lesson. Now, the critical question: will silver fall below $79? Will the crash continue, or have we seen the bottom? On one side, you have the paper market manipulation machine. As long as large institutional players want to push prices down, they can continue flooding the futures market with sell orders. The leverage in the paper market gives them enormous power to move prices short term. If the goal is to break the psychology of precious metals investors completely, we could absolutely see silver fall below $79, potentially even testing the 60s or 70s. On the other side, you have physical market fundamentals. Global silver production is approximately 840 million ounces per year. Industrial demand alone consumes about 520 million ounces, with solar panels accounting for roughly 140 million ounces and growing rapidly. Investment demand adds another 200 to 250 million ounces. The market is essentially balanced, with very little surplus. If physical buying accelerates at these lower prices, available supply could be exhausted quickly. And there's evidence that physical buying is indeed accelerating. The US Mint reported a significant uptick in Silver Eagle coin sales in the days following the crash. European dealers are reporting delays fulfilling orders due to high demand. Asian buyers, particularly in China and India, where silver has cultural significance, are reportedly buying aggressively. This creates a fascinating dynamic. If physical demand remains strong while paper prices fall, we could see a situation where the paper price keeps declining while physical silver becomes increasingly difficult to obtain at any price. This divergence cannot persist indefinitely. Eventually, either the paper market price rises to meet physical reality, or the paper market loses all credibility and becomes irrelevant to price discovery. If the latter happens, we could see the emergence of a two-tier market where paper silver trades at one price and physical silver commands a significant premium. This would be unprecedented in modern commodity markets, but we're living in unprecedented times. There's also the wild card of industrial supply chains. Silver mining companies need prices above certain levels to justify continued production. If prices stay depressed for too long, marginal mines will close, reducing future supply. This sets up a potential supply crisis down the road, which would eventually send prices soaring again. Trump and Warsh are betting they can thread this needle, suppressing prices enough to defend the dollar and punish dollar skeptics, but not so much that they trigger a physical supply crisis or completely destroy the precious metals market. It's a high-wire act requiring precise execution. But here's what history tells us. Market manipulations always eventually fail. The Hunt brothers tried to corner silver in 1980 and were crushed, but silver prices eventually recovered and went even higher in the 2000s. Central banks tried to suppress gold prices through the London Gold Pool in the 1960s, and that scheme ultimately collapsed, leading to gold soaring in the 1970s. Markets have a way of finding equilibrium regardless of how powerful the manipulators are. The question isn't whether this manipulation will eventually fail. The question is how long it can be sustained and how much pain it will inflict before it fails. What makes this situation particularly volatile is the geopolitical backdrop. We're not living in a stable world where economic policy can be executed in isolation. There are ongoing conflicts, rising tensions between major powers, supply chain disruptions, and deglobalization trends. Any of these factors could trigger a flight to safety that overwhelms the price suppression efforts. A military conflict, a sovereign debt crisis, a banking failure, or a currency crisis anywhere in the world could send precious metals soaring regardless of what the Fed does. Moreover, Trump's broader economic agenda introduces additional uncertainty. His administration is pursuing tariffs, reshoring of manufacturing, and economic nationalism. All of these policies are inherently inflationary over the medium term. Tariffs raise prices. Reshoring manufacturing means paying higher wages. At some point, these inflationary pressures will clash with Warsh's strong dollar policy, creating a policy contradiction that markets will exploit. There's one more critical factor most analysts are ignoring. The dollar's strength is being artificially maintained right now through this aggressive intervention, but the US economy carries over $36 trillion in national debt. The only way this debt remains serviceable is through either economic growth that outpaces debt accumulation or inflation that erodes the real value of the debt. A strong dollar policy makes the debt more expensive to service and makes inflation harder to achieve. This creates a fundamental tension that cannot be resolved without significant pain somewhere in the system. Kevin Warsh knows this. He lived through the 2008 crisis and saw how quickly confidence can evaporate. He understands that maintaining dollar credibility requires not just strong words but strong actions. The silver crash is that strong action, a demonstration that the Federal Reserve, under his leadership, will defend the dollar system aggressively. But every action has consequences. By demonstrating so clearly that precious metals markets can be manipulated, they're inadvertently proving exactly why people need to own physical assets outside the system. By creating such an obvious divergence between paper and physical prices, they're destroying confidence in the paper markets themselves. This could accelerate the very outcome they're trying to prevent. So where does this leave us? The silver crash of 2025 is not just about silver. It's a manifestation of a larger battle for control of the global financial system. On one side, the established dollar order, represented by Trump and Warsh, is fighting to maintain dominance through aggressive monetary and market policies. On the other side, nations, investors, and market participants are seeking alternatives to dollar dependence, with precious metals as a key component. The crash was designed to show that the dollar order still has teeth, that it can still inflict pain on those who bet against it. Whether it succeeds depends on what happens next. If physical demand evaporates and investors flee precious metals entirely, the strategy worked. But if physical demand remains strong and the divergence between paper and physical grows, this crash may be remembered as the moment when the paper manipulation scheme was finally exposed. Will silver fall below $79? It might. But whether it does or doesn't is less important than understanding what this crash represents. This is the opening chapter of what could be the greatest financial transformation of our lifetime. The hidden reason behind the 40% drop isn't just Kevin Warsh's nomination. It's the culmination of years of planning for this exact moment. It's a coordinated effort to defend the dollar system at a critical juncture in history. The choice you make now, whether to see through the manipulation and understand the larger forces at play, or to be swept up in the panic, will determine whether you're a victim of this wealth transfer or one of the few who profit from it. The game is being played at the highest levels of power. History shows us that those who understand the game and position themselves accordingly during moments of maximum chaos are the ones who build generational wealth. The silver crash isn't the end of the precious metal story. It might just be the greatest buying opportunity of this generation, disguised as a disaster. The question is, do you have the conviction to see what's really happening while everyone else is panicking? Because this story is far from over. In fact, it's just beginning.